Sorry, muted. No, not really. I mean, I think
No.
Mike's been a great mentor for us. Did a version of this last cohort that was really popular. And I'm excited to have such a broad audience for it this time, I think. One of the benefits of being remote, certainly.
Mm-hmm. All right.
Cool.
Want to take it away?
Yeah. So let me start by sharing my screen, and then I'll give everyone just like a brief introduction into who I am and why I'm here talking about this. So let me just pull this up. Can you all see my screen? Cool.
Yep.
Say hey everyone. My name is Mike Wilner. So I'm here from the AWS Startup Business Development Team, which I'll explain that really quickly because it might be weird. Why is someone from AWS talking about fundraising? I'll explain that briefly and then I'll tell you more of my story. So you have some context before we jump into things. But the team I'm on at AWS is basically a group of former founders, investors, and startup executives whose job it is to help startups. Now, part of that is helping startups with AWS. So we provide things like credits, training, and even connections to solutions architects so that you can figure out how to build on AWS for your startup. I can send information out after this, but as SOSV companies, you all have access to credits and some other benefits that I can share. But the other way that we help startups is on the business side. And that's really what we're here to talk about today in regards to fundraising. And so in terms of my backstory, I'm one of the ones that's a former founder on our team. So my quick story is I was a Venture for America fellow back in 2013. So I worked for startups in Detroit for 2 years. I then moved to Philadelphia to start my own company, which was called Compass, not the real estate Compass, I wish. It was basically a freelance marketplace for web designers. So think Upwork, but specifically for web design. Went through the process of raising angel capital, raising seed capital, growing the business, doing really well for a while, then doing not so well. So we ended up having to pivot the business pretty hard and basically sold it off with an asset sale, but it was basically a 4-year startup journey that I went through. So I've seen a lot of the good stuff, a lot of the bad stuff, have plenty of scar tissue. And after winding things down there, I basically spent 8 months helping early stage investors invest in startups and working with startups to help them raise seed rounds. And one of the things that happened as I was doing that is I was giving a lot of the same advice over and over again and working with some friends that had also run startups and raised from some big VCs and ended up pretty spontaneously codifying all the things that we were helping founders with into a book, right? So did not think I was going to become an author, but it kind of happened spontaneously because we just were repeating a lot of the same advice. And so wrote that book, oversubscribed, which is about fundraising. I can actually share a free version with everyone on this call if you're interested. But that kind of led me to this team where now I'm at AWS. I work with accelerators and incubators around the US and Canada, help their founders with AWS, but also help with things like this, with fundraising. And so what we're going to talk about today is basically this presentation, raising a seed round efficiently. To be honest, if I had to rename this to something that was maybe a little less kosher, it would be how to generate FOMO with investors. Or basically, how would I go about fundraising today if I were raising a startup? And so we're going to go through all of this. One of the things I'll mention before I jump off here is I am going to send out the slides afterwards. So don't feel like you have to jot down a ton of notes. We will be sending this out afterwards. And I'm going to be pausing throughout so that we can address any questions that folks do have. So those are two things I'll start by saying. So if you have questions you want to throw in the chat, feel free to. I may not like stop right away and answer them, but we'll also pause along the way and then have plenty of time at the end for more extensive Q&A. But with that, let's get started. So fundraising 201. So I like to start with a pretty basic question, which is what is seed funding? Because it's important to understand how nuanced this could be before jumping in. So it's a lot more than just venture capital. This is what a lot of founders think about when they think about seed capital. But on the non-venture capital side, you have things like non-dilutive grants, friends and family, angels, angel funds and groups, which can sometimes be very difficult, and accelerators like SOSV accelerators, right? And then on the VC side, you have more nuance here as well. You have pre-seed VCs, you have seed stage VCs, you have multi-stage VCs, which may invest at the seed stage, but also at Series A and B, and then even corporate VCs. And the one takeaway to have here before we jump into this is that all of these different types of investors are different. And it's really tempting, and a lot of founders do this, of painting all investors with a broad brush as I need to pitch investors, I need to raise money from investors. But understanding how each of these different types of investors work and how they think is really, really important. And so one thing I'll press on throughout this presentation is to really think through the perspective of the investor and understand how their business works, because that's going to help you a lot when you're thinking about your fundraise. So how long should fundraising take? I'll actually let people shout it out. Anyone have any guesses here of how long they think fundraising should take?
Okay, I start on December. I am still looking for fundraising.
Yeah, to be clear, my first time raising money took me 6 months. That's something I hear a lot of. It's like 6 months. I hear people say a year. I hear people say it never stops. I hear some people say 3 months. But the truth is, and this is what we're going to get at, experienced founders who've done this before can put a seed round together in as quickly as a month. And this is a lot of what we're going to be talking about here, because ultimately, I don't think anyone here started a company because they really enjoy fundraising and want to do it all the time. The key here is to do this as efficiently and as quickly as possible. And that's kind of what we're going to talk about today. And so what's the secret of these founders who figure this out? The key is to generate authentic competition for your round, giving investors FOMO and a sense of urgency. Ultimately, this is what everything really comes down to, is being able to accomplish this. Now, way easier said than done. It's nice to be like, oh yeah, generate FOMO. Sounds good. But there are some practical steps that you can actually take to do this, and some practical ways you can approach your fundraise, which is what we're going to be unpacking a lot today. So here's a quick overview of what we're going to cover. We're going to start with just establishing some ground rules so that we understand kind of what are some basic things we need to know. We'll talk about drafting your round composition, so thinking about the types of investors you want to have in your round. Then we'll talk about crafting your fundraising narrative, so how do you tell the story around your fundraise in this way that can help you move quickly. Then we'll talk about building your initial funnel, so how do you kind of build that funnel for your raise, initiating fundraising mode and stacking up meetings, and then finally pitching and closing. So we're really going to talk about the full spectrum today and how all of these different things work together. So let's start with 5 ground rules for raising a seed round. So rule number 1, really important. You're either in full fundraising mode or you're not. It's pretty black and white. And as a founder, it can be really tempting to kind of fall into the gray area. Right? You're working on building your business, but some advisors offer you an introduction to an investor. You say, sure, why not? Sounds like a good person to talk to. So you take a meeting, that one investor asks you for a deck. Now all of a sudden you're putting a deck together for one investor, right? And you haven't really built a fundraise process and really approached your fundraise thoughtfully, but you're kind of already in the process or kind of in the middle. You really want to avoid that, right? This is a really deliberate thing, where you turn fundraising mode on and then you're pretty focused on it. And we'll talk about what that looks like a little bit more. The one thing I want to emphasize right now, and this is especially true given current events, is one of the best things you can ever say to an investor is that you are not fundraising, right? So even if you are thinking about fundraising in the next couple of months and it's top of mind for you, if you tell an investor who you get introduced to, like, hey, we're not fundraising right now, we're focused on these milestones, we might fundraise in the future, you should feel totally fine saying that. And that's going to make them want to get to know you more and want to be more engaged with you, because they're going to want to be the first to know when you actually are fundraising. And so be very deliberate about when you turn that switch on and off, and feel free to tell an investor straight up that you are not fundraising right now. Even if you know that in 2 months, you might be turning it on, that is something you can use to your advantage. Rule number 2, fundraising should be one person's full-time job. So this was a mistake that I made when I was raising my first round. I tried to spend 50% of my time fundraising, 50% of my time on sales. During that time, I was not great at either of those things, right? And so you want to be able to put yourself in a position where you can spend 80% of your time really focused on fundraising until it's done. Right? And that really can help you get over the hump and get things to move really quickly. And so one of the first things you'll need to do as a founder is figure out how you can delegate certain operational responsibilities to other team members so that you actually can put your head down and fundraise. The other thing I'll say here is you want other team members to not be distracted by this. Usually it's the CEO, but sometimes it's the COO who's fundraising, but really should be one person kind of taking on the burden and saving others from having to worry about this. Rule number 3, fundraise in parallel, not in sequence, and put yourself in a position to say no. So when I say not in sequence, what I mean is you should not be going to one investor, getting to a yes or a no, and then going to another investor, getting to a yes or a no. You need to be doing this in parallel so that you're having many conversations with many investors at the same time, right? And the litmus test here is that well-run fundraisers, at the very end of them, founders are put in the awkward position where they have to tell investors who want to write checks that they can't because there is no more room, right? And so that's really how you should be approaching this. And one of the rules of thumb we'll talk about today, we'll come back to this, is the 3-by-1 rule, which basically says for every spot you have available in your round, and we'll talk about how to come up with those spots, but for every spot you have available in your round, you want to be in final diligence with 3 investors at the same time, right? That is really the math that kind of kickstarts that FOMO and that authentic competition, right? If you are at the final stages with 3 investors and literally only one of them will be able to invest, that is when people start sending term sheets really quickly. That is when things really start to move. And so we'll work backwards from that 3-by-1 rule when we talk about prospecting and other things, but that is really how you should be thinking about this. Rule number 4, time kills all deals. So this applies to individual investors, but it also applies to your round as a whole. So with individual investors, the longer you give an investor to think about things, the higher the chances that they're going to say no. So you really need to be putting yourself in a position where investors do have a tight time frame where they do have to make a high conviction decision, right? And so you want to be able to move people really quickly along in this process. So speed really matters. This also regards your entire round, because the longer you are fundraising, the harder it's going to get. Ultimately, if you are fundraising for 3, 4, 5, 6 months, that can start to become a negative signal to other investors, because you've been fundraising all this time. Why haven't you closed the round? Maybe there's something wrong with the business that we're not seeing, right? So being able to be in market for as short a period of time as possible is really important. Now, I will say with all of this, with trying to move really quickly, with doing this in a month, that doesn't mean you're just going to start working on fundraising for a month and then it's going to be done. You may spend 2 months kind of prepping to fundraise, right? And getting ready to where the narrative's in a really good spot and you have your funnel kind of built up. And then you may kind of flip the switch on really quickly and try to move as quickly as possible and do it in a month. But you really want to narrow the window of time that you are in market with your fundraise so that it can feel like a really competitive deal that investors are trying to get into. Rule number 5, this is especially important right now. Optionality makes everything easier. So look, if you have 4 months of runway and you're burning money at a high clip and you need to fundraise, not to say you can't do it, like a lot of people end up raising money that way, but it is harder. When you have optionality, which means you actually don't need the money to sustain yourself, that is going to make things a lot easier, right? And so you can get creative here. This may mean that you may not actually want things to stay the same, right? Like you may be taking a salary that is too low, and personally you don't want to sustain that, but maybe it helps you get to a point where you're like just barely breaking even, or you can kind of like see the point of break even, and you could get there and scrap your way there if you really wanted to. Having that optionality so that you don't actually need an investor's money, first of all, it changes how you will approach this psychologically and will give you more confidence when you're talking to these investors, but it genuinely does put you in a position of strength through these conversations. Was just working with a founder who had been fundraising and was doing pretty well with the fundraise, but it wasn't like really closing. They were like getting some commitments, but had yet to really like close the round. And then their business became cash flow positive, right? And not to a point that they wanted to sustain. They were like not taking big salaries or anything like that. But that simple change of like, oh, we actually, if we stopped fundraising now, we would be okay. Getting to that position made it really easy for them to actually raise the rest of the round, right? And so having that optionality is going to make everything easier if you can achieve it. So we're going to move into some of the more practical parts here, starting with drafting your round composition. But I do want to pause really quickly to see if anyone has any questions on some of these ground rules before we keep going.
I see a few questions in the chat. Do we want to capture those for later, or do we want to go through them now?
Let me take a look here. Sorry, I'm just pulling that up. I'm having trouble pulling up the chat just based on my screen setup. Are there any ones you want to call out? Maybe like moderate a little bit, and then I can address those.
Hey, yep. I basically asked the question in the chat. I'm Yonglin from Malaysia. So, because you mentioned that we shouldn't be saying that we are fundraising right now. So, like towards the end of the call, usually the investor will be asking like, hey, like how much would you like to raise for your next round? So in that case, having said that we are not raising a round, what should we be answering?
Yeah, it's a good question. I think like if you're having a pure like advisor type conversation, right, and someone asks about your fundraising plans, I think it helps to be vague, right? So, you know, if you say you're not fundraising because you're not, but then you say you're raising, $1 million on a $7 million valuation cap on a safe, right? Then it's like, oh, well, you actually are fundraising. And so I think being able to say something like, look, we haven't made those decisions yet. We could see doing something in the next, this many months, but we're still figuring out what that raise would be used for. So I think if you haven't really ironed that out, don't try to provide certainty that you don't actually have. Right. So it actually is okay to not have an answer there. And just saying that you're focused on these milestones and, over the next couple of months, you might consider raising a round and you just haven't gotten there yet is a totally fine thing to say.
Okay. So following up from the answer. So you also mentioned that we should push the entire fundraising process as quick as we can, probably to close it within 1 month or 2 months. So in a case where we say that, hey, you know what, we are not really raising, we probably would want to raise in the next 6 months, we're still thinking about that. So then we wouldn't have like a reason for us to follow up after the call. Isn't that right? So how do we actually say that, we are not fundraising, but we sort of push the process to be faster?
Yeah. So we'll talk about this a little bit more with prospecting and building relationships before you fundraise, which we'll get to. The short answer is that you should be having conversations with people before you fundraise. Those people should be folks who can actually help your business today, right? So like, those are the folks you want to talk to, because then there is a reason for you to stay engaged, right? Like they can help with something, they can make an introduction, you can keep them posted with how things are evolving. So we'll talk about that a little bit more later, but that's the short answer. one really good question came through that I definitely want to address. I just pulled up the chat. And a few questions about this. Basically around, is this realistic in the current climate with investors trying to do this really quickly, generate FOMO? Look, the thing is, you're not going to tell investors that like you're generating FOMO, but the truth is that this is how investors make decisions. And so, yes, in this current moment, there is a lot of uncertainty, and some angel investors are pulling back. A lot of funds are maybe focusing on existing portfolios and doing fewer new deals than they would typically would, but new deals are still happening, right? And so things are getting more competitive as a founder, right? Because there's just less net new seed deals happening. But this is still how decisions get made, and people like to make high conviction decisions, right? And so I would say like you should acknowledge that these are really uncertain times, and we'll talk about how to deal with investors. Part of it is having empathy and asking them questions about how they're making decisions, but ultimately decisions are still going to be made based on what are the competitive deals to get into, what are the best startups, and the way that a lot of investors look at that is based on how competitive it is, right? And so I think, look, the 1 month is a rule of thumb. Ultimately, you may try to do this in a month, and it may take 2 months. That's still better than 6 months. But you should still be trying to move as quickly as possible here. I will say that. Any other questions before we keep moving? Cool. Let's talk about round composition. So the key here is to create scarcity by working backwards from your ideal cap table, right? So this might help in terms of how to think about generating FOMO practically here, especially in the current environment. So it's pretty daunting. Let's say you want to raise a $2 million seed round. That feels very daunting, right? I've got to go scrap together $2 million, right? I've got to go talk to a bunch of investors and figure out where I'm going to find this $2 million. But if you work backwards from what your ideal cap table would look like at the end of the round, it suddenly does become a bit easier. So for example, let's say this is a $2 million round. And by the way, this applies whether it's a $250K round, $2 million round, or $20 million round. But in a $2 million seed round, that may mean that you have one lead VC who's writing an $800,000 check, 2 follow-on VCs writing a combined 600, and then 5 angels writing a combined 600, right? This is just an example. It may look differently for you. But basically what we've done here is we've taken this $2 million seed round, which is daunting, and we've flipped it on its head. And we've said, we've got room for 8 investors in this round. Suddenly it becomes a lot easier to create scarcity and create competition. And this transfers from what felt like an ask for money exercise to a recruiting exercise, right? So this is a lot like you would deal with a hiring process, right? And honestly, this is an opportunity. This is recruiting. This is an opportunity to add people to your team. And so when you think about how you want to compose your round, you should think pretty granularly about who you want to add to your team. For example, in this case, I said 5 angels. You can get a lot more specific than that, right? You could say, you know, you want to have 2 angels that are former founders who have built successful companies in your space and can like help you see around corners, and 2 angels who are executives at Fortune 1000 companies that have dealt with a certain part of the business that you're going to need to build, right? Like you can get pretty specific with who these investor personas are. And honestly, the more specific you are, the easier it's going to be to target prospective investors, and the easier it's going to be to create scarcity, right? For example, with 2 spots available for follow-on VCs, if you're having conversations with VCs and they give you the classic line, which is, we won't lead, but we'll follow, you can then say like, okay, that's fine. I understand you're not writing lead checks, but just so you know, we really only have 2 spots available for VCs writing smaller checks. So are you saying that that's one of the spots you want to take? And they might still kind of string you along, but in a lot of cases, you can actually get them to make a decision, because it's not like they've got this $2 million round that they have plenty of room to like float around in. You're really condensing it to that there are only 2 spots for people like them. And you're probably talking to 8 or 9 others that fit their persona. And so those 2 spots are going to get taken up, right? And that's how you can start to create scarcity, by breaking your round into these different components, and building a funnel based on them. So in order to think about this type of round composition, helps to understand how investors work, right? Because there are lots of different types of investors, as we talked about before. So we're going to start with VC, and we're going to start by having some empathy for VCs. So being a successful VC is really hard. We're going to go through an example of a $10 million fund that makes 33 investments, just to help you understand how their business works. So in this example, let's say 10 of the startups fail, 11 return their money, 6 generate 3x returns, 3 generate 5x returns, 2 are 20x returns, and then there's 1 big 50x return. So, with this portfolio, even with 6 companies that are doing over 5x and 1 that's doing 50x, this VC is doing pretty well. They're not killing it by any means. They're doing pretty well. Now, if you take this 1 50x in return that the VC had, and instead that company was a 5x return, which is, still pretty good for the company, right? The 5x the valuation. That VC goes from doing pretty well to doing not well at all, right? And probably is not going to be able to raise another fund. And so this is all to say that VC is an outlier game, right? And VCs are looking for really big returns. So the seed VC rule of thumb is they need to believe that every investment has the potential to return the entire fund, which is roughly 50x when you think about dilution. So this is something I struggled with a lot with my startup. So for me personally, I talked to an investor when I was raising my first round, and he said, Mike, this is a good business, really like what you're doing here. Unfortunately, we can only see this becoming like a $200 million company at the most, and that's just not big enough for us. And in my head, I'm thinking, well, man, I'm 23 years old. Building a $200 million company sounds pretty good to me. But ultimately, they need to believe it can be bigger, right? So a VC may ultimately be okay with a $200 million exit, but they need to believe that there's more upside there. Because if the ceiling is, a $200 million exit, then it's probably going to be more of like a 5x return if we're really thinking realistically. So they need to believe that it has really big upside. The other thing here is seed stage VCs will want you to keep climbing that VC path. So if I'm a new seed VC fund manager, it's going to take 5 or more years for me to be able to show that the investment that I made was actually a good investment. And so what I will want to happen in the meantime is I'll want my seed investments to go and raise subsequent rounds of capital at higher valuations within the next 12 to 18 months, because that's going to allow me to go back to my investors and say, hey, look at this investment I made. I invested at a $6 million valuation or a $7 million valuation, and they just raised a Series A at a $15 million valuation. I'm a really good seed investor, right? And so they will want you to raise subsequent rounds of capital. So if you're thinking you're just going to raise a quick seed round and then be profitable and never raise money again, you're going to have some harder conversations with the VCs you're talking to, because that may not be what they want. So now let's swing to the other side of the fence and think about angel investors. So angel investors have much more diverse motivations. Some of them may think like VCs, right? Because they're aspiring VCs, and it's going to be pretty similar to how VCs think. But some angels, they may really want to invest in you because they just believe in you as an entrepreneur. They may be from the same hometown and want to support founders in that hometown. They may be bored and be interested in the space that you're building in and want to get a closer look into your industry, right? There are a lot of different reasons why an angel investor may want to invest. And one of the things we'll talk about is you should ask what motivates them, right? That's going to help you figure out if they're a good fit. They also may have a lower bar for what a good outcome is. So while VCs will want really big returns, Some angel investors may be totally fine with a 3 to 5x return after a couple of years, right? That could be a great outcome for them. And so it's really good to understand what success looks like for them. And finally, angel investors may be a lot more passively involved. So while VCs may take board seats, may influence your decision-making, may be pretty heavy-handed in some ways, angel investors are much more likely to support you and be cheerleaders from the sideline, but aren't going to push you to make certain decisions. So what some founders do if they want to retain a lot of decision-making autonomy is they may raise pretty sizable angel rounds, right, that are made up of angels who are going to let them drive and be there to support, but are not going to influence things in too many ways. So it really depends on what you want. So some takeaways from round composition. First, understand how the investor's business works, whether they're an angel, accelerator, pre-seed VC, corporate VC, multi-stage VC. Really understand how their business works and what motivates them. Make sure your goals are aligned with the investors. If there's not goal alignment, there are too many investors out there for you to waste any time with investors who you are not aligned with. Be deliberate about the types of investors you want in your round, right? This is a recruiting exercise. It's your opportunity to bring people onto the team, and that's how you should be thinking about it. So really think through, where you have some gaps and where you could really use some help. And then finally, draft your round composition before you start talking to investors. If you do that, it's going to enable you to just come across as a lot more competent as a founder and create more of a sense of urgency and a sense of competition by having, ways that you're kind of bucketing founders into parts of your round that you've allocated, right? So those are some takeaways from round composition. We're going to jump into crafting a fundraising narrative next, but I want to pause to see if anyone has any questions about round composition. We have some questions here in the chat that I can address, but anyone have any? Let me talk about hardware that came up here. We'll talk about hardware a little bit in crafting your fundraising narrative, because one of the key differences between hardware and software is in terms of like how you talk about progress, right? So, if you're building a B2B SaaS company, investors are going to look for some form of traction. Whereas if you're building a hardware company, the production cycles are a lot longer, right? And the way that you talk about progress and being in market, you may be raising a seed round before you're actually in market with a product and have revenue, right? And so we'll talk about that a little bit more in terms of how you frame that in terms of progress. The other thing to think about in terms of hardware and in terms of round allocation is there is potential to think about round allocation or round composition, in terms of working capital versus growth capital, right? So when it comes to, if you need to raise $2 million, and let's say, $500,000 for that is just for like working capital for building an initial batch of your product, that is lower risk capital than capital that you are raising to invest in growth, right? And so what I've seen founders do is they may, if you need to raise $2 million, maybe $1 million of it is through venture debt or some other form of capital that is better for lower risk investments. And then the other $1 million that you're raising could be, angel investors, VCs that are, going to be getting equity in the company. Right. And so I think that's something that you should think about is like, what is the capital being used for? And then therefore, what should the risk profile of that capital be? Because in some cases, it may not make sense. Like it may be really expensive to raise equity to, manufacture a product that you already have placement orders for, right? It might be better just to take out like a loan. That may be a cheaper way of raising that money when you think about it. So I think that there are some nuances there when you think about round composition.
Uh, can you give an example on how do we in a conversation bring out that we have a composition in our round?
So, sorry, can you repeat the question? I just want to make sure I understand what kind of example you're looking for.
Yeah, so what kind of example? It's probably like this, I mean, like during a real life scenario where we're talking to the investors, in what scenario, in what case can we comfortably bring out that topic? That, you know, we have a competition and which one you want to be in and all kind of stuff, yeah.
Yeah. So, you know, conversationally, there's a reason I call this draft your round composition, because as you make contact with investors, this might evolve as you're going through raising your round. For example, if you talk to someone who knows 3 other angel investors that they want to bring into the round and you had not provided for that much room, you might want to be flexible, right? But I think it is totally fine to have this conversation, right? Like this is you telling the investor, even in an early conversation, how you're thinking about your round composition. And so I would encourage you to like just say what you're thinking. Now, if you're drafting it, you can just say, hey, this is how we're thinking about it. We want angels in this round for this reason. We want these types of investors in the round for this reason. So you should have good reasoning behind it. And then you can tell them how you think they might fit in. And they might actually say like, actually, you know, we like to write bigger checks, or we like to, you know, write smaller checks, or we see ourselves in this way. And it's a really good way to have a conversation. But by no means is this like, this is where we think you fit, like fit in here, or let's stop talking, right? Because you may want to listen more in terms of how they work. So we've got some good questions here I want to tackle. One is around being in a niche industry where not many people understand it. We'll talk about this with prospecting, but I would highly advise going to people who understand your industry a lot. Those people are likely to know all of the investors. Even if the people you talk to first are not investors, they are likely to be well networked with people who are actively interested in investing in that industry. So that's where it's helpful. And we'll talk about like building relationships with other founders and networked people in a second during prospecting, but that's how I would address that part. You want to be spending your time with people who, you know, understand your product. I know we've got some food companies here. So one of my favorite examples was a good friend of mine is the founder of Banza, the chickpea pasta company. And when he was fundraising, one of the things he said was like, he would talk to some investors that just didn't like the product. They didn't like how it tasted. And he was like, well, if they don't like how it tastes, you're not going to have much success with them. So like go to people who understand and appreciate your product and love your product and understand it. That's always a good place to start. Even if those people don't end up being investors, they are most likely to connect you to people who could be. Let's see. One question here is good. What's the smart way or channel to research whether VCs have dry powder to invest? You can do some research based on how recently they raised a fund and make your own inferences there. But ultimately, the best way to learn this is through conversations with other founders who have recently had conversations with those investors, which we'll talk about in a second, and talking to them yourself, right? And so going through this process, you're going to be talking to different people who have deeper insight into which investors have dry powder. And so like looking online is one thing, but having conversations with people that have better intelligence is going to be the other way. We'll talk about that during prospecting. Cool. Well, we can save some of these questions for the end. We've got a few rolling in, but let me keep going and then we'll keep breaking for questions. So let's talk about crafting your fundraising narrative. So what is a fundraising narrative? The truth here is that it is not quite a pitch deck. It's higher level than your pitch deck. And in my opinion, you should be thinking about your fundraising narrative before you create a pitch deck. So a fundraising narrative is a concise explanation of what you do, what's most compelling about your business, why you're raising money, and your long-term vision, right? It's really concise, really memorable. The way you should be thinking about this is that when you leave a conversation with an investor and they have 20 other meetings with founders, they should be able to remember what your fundraising narrative is. And if they're talking to another investor friend who asks them, have you seen anything interesting recently? They should be able to recite your narrative to that investor, right? So it needs to be really, really, really tight and crisp. So we're going to break this down, but a good narrative can do the following in 20 seconds. So the first 10 seconds, you need to simply explain what you do. I want to emphasize simply here, and then communicate the single thing that is most compelling about your business and the deal that an investor needs to remember. And then with the second 10 seconds, you can outline your progress to date, future milestones, and long-term vision. We're going to unpack this with a few examples. I'm going to start with a bad example of simply explaining what you do. And so I'm going to show this, and I want everyone to read this. Let me know if anyone knows what this company does.
Nobody?
What was that?
I was like, nobody has a thought?
Yeah.
I already know because I saw this last time.
Yeah, that's right. I should start updating these with more examples. Yeah, I mean, look, the first time I read this, I read it 3 times. I started to get a little insecure that maybe I wasn't that smart. Ultimately, I realized that this is just a bad company description. Wow, Cameron guessed it right on the money. I don't know if Cameron's seen this before, but this is the actual description. An analytics tool for podcasters, right? So shout out to Cameron on that one. I'll just say, Cameron, I have never had someone get this right. So this is a first. But yeah, look, you're going to have plenty of time to tell investors about the vision of what you're building. But ultimately, if an investor can't hold in their head really simply, okay, what do they do? Who do they do it for? And what is the value they provide? Then ultimately, they're going to tune it out before they can hear your long-term vision. And a lot of founders get tripped up on trying to be by the way, this is a mistake I used to make. We're a marketplace for creative professionals to collaborate with businesses. I used to do this too. And investors would be like, okay, but what do you do? Right? And so make sure you're being really simple with this. You're going to have plenty of time to talk about your vision, but make sure they can quickly understand what you do. Then you want to communicate the single thing that's most compelling. So really, what is the one reason that an investor is going to make an investment decision? And so this can be a story around traction, your team, something in the market that you have an insight on, a case study where you've saved a customer 90% of their costs on a certain thing, or customer feedback from a private beta that is unbelievably compelling. It can be a combination of these things, but it really needs to be a simple thing that you've distilled that is going to be the one reason why an investor invests. Too frequently, founders try to check all of the boxes, right? Here's our problem, here's the solution, it's a big market, here's the competitive differentiation, here's all this stuff that we're checking the boxes of. Investors will want you to check those boxes, but in order to make a decision, there needs to be something that they come back to, which is the reason why they are making the investment. And so you need to kind of come up with what that is. So here's a good example. We're an analytics tool for podcasters, and we're a team of former podcast producers who produced 5 of the 20 most downloaded podcasts of all time. And so if I'm an investor here, I know that if there is a team to work on this problem, it is probably this team. And the reason I'm investing is because they know how podcast production works at the highest level. And so they are the ones to solve this problem, right? And so that's one example. That's with the team. I've seen other examples where founders have unlocked crazy, compelling go-to-market channels that are really insightful and non-obvious. I've seen it where some founders have built economics into their business that are so strong, where they have an LTV to CAC ratio and just economics that are so impressive that it's oh wow, this is really impressive investment. I've seen customer testimonials from like a pilot customer that show like a Fortune 1000 company raving about how the product is going to change how an entire department works, right? Like it can be a lot of different things, but it's going to be the one thing that an investor comes back to. And so this is like requires a lot of thought and reflection. But you need to come back to that one reason why an investor is going to make the investment. Then the third thing here is to articulate milestones of de-risking to show your progress in future plans. So milestones of de-risking. Let's talk about this for a second. So frequently founders think they have to be like, we're doing 5K in revenue per month, or we have this many users, or insert vanity metric here. Now, investors do care a little bit about those vanity metrics, but the reason they care is because they're trying to understand how much you've de-risked about the business. And so when they ask about revenue, when you talk about revenue, what they're really thinking about in terms of early stage revenue is, have you shown that people will pay for this service? Have you shown that you have good retention, right? Like those are the things that they actually care about understanding. And so better than jumping to vanity metrics, it's important to start with the milestones of de-risking. So what progress have you made to date? So what have you figured out about your business? So in the context of hardware versus software, at the seed stage, a software company, in terms of what a software company needs to de-risk, they need to de-risk things like customers will pay for the product, they will use it on an ongoing basis, right? Like it fits into their workflow. Those are the types of things you need to de-risk. Whereas for a hardware company, sometimes what you need to de-risk is we've figured out the supply chain and it is possible for us to build this and customers want it. Right, you don't necessarily need to have figured out everything with the full customer lifecycle and lifetime value, but you've figured out some of the earlier big risks that exist with a hardware company, right? And so when investors think about things from whether they're hardware, food, software investors, a lot of times they're just thinking about what has this company de-risked, and they're going to place different values on different things that you've de-risked based on the type of company that you are. And so really try to think about what have you figured out about this business to date. Then the next milestone. So what is the biggest risk that you need to address? One of the best things you can do when talking to an investor is rather than having them try to figure out what the biggest risk is, you just tell them right away, right? So we'll look at an example here, but that is super refreshing as an investor. When a founder just tells me like, this is what we figured out, this is the big thing that we need to figure out. And if we don't figure this out, then we're screwed. And that is why we're raising money to figure this big risk out. One thing I want to mention here, if you had no huge risks, you would just go to a bank, take out a $10 million loan and start printing money, right? So early stage startups have really big risks. If you do not proactively tell the investor what the biggest risk is, they are going to come to their own conclusions, right? And so make sure you are communicating this to the investor. It makes you look really good as a founder, and they're going to be looking for what this is anyway. And then finally, the future. If you de-risk that next milestone, so if you achieve what you're trying to do with this round, what does the future then hold, right? And that's where you can really start to tap into the imagination of an investor and really have a good conversation around that upside. So let's look at a bad example. And by the way, like this is pretty close to what my first fundraising narrative was. So and I see a lot of founders do this. We have 20 customers and we're raising $2 million to continue building out our product and hire a sales team, right? I see this a lot. 20 customers does not tell me much, right? You haven't really told me the so what behind having 20 customers. Raising $2 million to build out a product and hire a sales team. Okay, if you're raising $2 million, I would hope you're going to invest in product and growth, right? Like I assume that's going to happen, but you haven't really told me what you're going to achieve and figure out with this round. And that's what I care about as an investor. And so let's look at a good example of how to frame this. We found product market fit on a small scale with 20 independent podcasters paying for our product and using it for all of their shows, right? So right away, I've said product market fit on a small scale. Cool. Now we're raising $2 million to find a repeatable customer acquisition strategy so we can start dominating the independent podcaster market. So with this, I'm acknowledging that we have not figured out customer acquisition. If we had figured that out, we would be growing a lot, right? So we're raising this round to figure that out. Once we do that, we can go up market to podcast studios, which will give us the most advanced podcast data set in the world, right? And so this is when, especially if you're talking to a VC, you can start to tap into what is possible if we're able to figure this next thing out. And then if I'm a VC having this conversation to you, I'm starting to pitch you on what is possible. Like, wow, okay, if you're working with all of these podcasts studios and you have all this data, you could create, an ad network on top of that, or you could, you could do all these other things. And that's when you start to really get into some fun conversations that investors really like having. So you need to support this narrative with a financial model. If we look back to what we talked about before, or just in that last slide, a lot of it were qualitative statements, right? Product market fit on a small scale. We're going to find a repeatable customer acquisition strategy, right? You want to lead with the qualitative stuff of like, what are you going to figure out? What are you going to work on? But then you do need to back it up with numbers, right? And so when it comes to financial models, the goal is not to, show that you used to work at an investment bank and you can make like a really rigorous, cash flow statement. The goal is to, one, verify the story that you're telling and what that narrative is and back it up with numbers, but also to show the assumptions that you're making. So a good financial model with a fundraise can be a mechanism to have really good conversations with investors where if an investor tells you, you know what, I think you're being too aggressive with your cost of acquisition assumptions, right? Or, you know what, I think you can be more efficient with the amount of customer service reps you have for every customer, right? You can actually pull out the financial model and actually play around with those assumptions and see what happens to the business. And it's a really good way of having a conversation about the key business drivers, but also showing the investors that you really understand the drivers behind your business. And that is really what investors are looking for when they're looking at financial models. They know at the early stages that it's a lot of assumptions. They just want to know that you understand the assumptions that you're making, and they want to be able to have those conversations with you. So that's the role that a financial model plays in all of this. Some takeaways from fundraising narratives. One, keep it simple and concise. Frame progress and future milestones in terms of de-risking, right? Don't put too much weight on those vanity metrics. And then back up your narrative with math. So next, we're going to talk about building your funnel and talk about the rest of this process. Does anyone have any questions about fundraising narrative? We have some questions in the chat that I'll go back to that came along the way, but any questions on fundraising narrative specifically? Well, I'll go back to some of these questions in the chat and feel free to chime in if you have questions around fundraising narrative. So going back to FOMO, someone said, I've heard a few times, mainly on podcasts, with investors saying, if I get pushed to make a decision, it seems tacky and I'm out. How would you say that the best way is to tactfully word, you're going to need to make an investment? You are going to need to make an investment quickly. So really good question. And we'll talk about this a little bit. When you first have a meeting with an investor, the first thing you should ask is what their decision-making process looks like, because you do not want to push an investor to make a decision faster than they are actually able to do that, right? And so I think you don't want to make up dates like I'm going to need a decision in 3 days, or I'm going to need a decision in 5 days, or I'm going to need a decision by this date. You're going to just want to refer to the math of your investment funnel, right? So rather than saying, I need a decision quickly, or I need a decision by the end of this week, you can say things like, I've got 3 more meetings this week, and I don't know when things are going to be closed, but things are moving pretty quickly, right? So the vagueness with that is actually better than saying you have 1 day, or you have 3 days, or you have a week, or you have 2 weeks. You want to convey the sense that it's moving quickly, but without coming up with a date, because ultimately that can make you look bad. If you say, I need to hear your decision in a week, and a week goes by and you don't hear anything, and then you follow back up and your round still isn't closed, that makes you look bad, right? So rather than like setting arbitrary dates, it's better to be vague and just even talk to them openly about the funnel that you have and like the volume of conversations that you're having. All right, question came into the chat around the narrative. Investors mostly avoid risks. Does this make sense to talk about a 5%? Sorry, let me just read this. Yes, does it make sense to talk about like the 5% that you figured out versus the 95% that you haven't figured out? Look, the early stage investors are basically professional risk takers, right? So they are comfortable with a high degree of risk. That's why they invest in the seed stage. Now, at the same time, they are good at mitigating risk. And so what they're trying to figure out is what has been de-risked about the business. And so ultimately you are going to have to talk about what you figured out. And if what you figured out if what you have figured out about the business is not enough for seed stage investors, then you might just need to make more progress in terms of de-risking the business before raising a seed round, right? And so I think when you're talking to investors, even before you're fundraising, one really healthy question to ask is, hey, like, what do you like to see de-risked about hardware investments before you invest, right? What do you like to see de-risked about food investments, about B2B SaaS investments, about blockchain investments? Like, what do you like to see de-risked? And they will tell you, like, you know what, for hardware, we like to see a prototype. We like to see initial demand. We like to see these milestones hit. So you can ask those things before you're even fundraising. It's a really good thing to talk about pre-raise. That'll help you understand what you actually need to get to before you start having those conversations again. But yeah, that answers that question, I hope. Any other questions about fundraising narrative before we keep going? Cool. Well, let's go into building your initial funnel. So we talked about this before, creating scarcity by working backwards from your ideal cap table. Now we need to build a funnel for this. So you want to work backwards from that 3x1 rule, which means if you're planning to close 8 different investors, you may be in final diligence at different points in time with 3 for every one you want to close, which means you may have initial meetings with 10 for every one you want to close, which means you may start with 20 prospects for every one you want to close. So in this case, we're quickly seeing why this is a full-time job, right? In this case, we're starting with 160 prospects. And along the way, we're going to pick up many more prospects, right? Because these prospects are just assumptions that we're making. But this is what the funnel could and should look like, right? And so you need to be in a position where you're ready to go all in on this process and start activating people quickly and driving them down this funnel. Now, activating all these different types of investors at once can be pretty daunting, right? So if you feel really comfortable in doing this, like you've got a good prospect list, you've been warming up relationships, and you feel like you can activate this all at once and like slot investors into their respective buckets and get them all to move quickly, by all means, do it all at once. But staggering can work to your advantage. And what I mean by staggering is you don't have to raise from all these different types of investors at once. You could start with angels, right? And I want to address what I believe to be a really big fallacy with fundraising advice, which is you'll hear a lot of times, get a lead investor first, right? Now, if you can, absolutely get a lead investor first. It makes everything a lot easier if you have a lead investor first. But that is a pretty big chicken and egg problem, and you don't want to hinge your entire fundraise on getting a lead investor, right? And so I'll use an example from a friend of mine who raised a $2.5 million round led by Khosla Ventures, right? The way that he did it was he had existing angel investors. And so he went to his existing angel investors first, told them that he was thinking of raising a round, got them to make initial commitments. Then he went to new angel investors, said, you know, we are going to be raising a round. We've got this much committed from existing investors. We've got this much left for angels, and got them committed. And that got him up to $1 million in commitments, right? And so he hadn't talked to any VCs at all yet. He was kind of going bottom up here. And along the way, he was setting milestones that he could easily achieve, right? With his existing investors, he wanted to get 500K locked in. And so he was able to like get that done and build on that momentum. With new angel investors, wanted another 500K. So he got that done and built on that initial momentum. Then he had conversations with smaller VCs and said, look, like we've got $1 million committed in this round. So by the time he's having those first conversations with VCs, this is already a pretty real round that's coming together pretty quickly. And he said, you know, we've got room for a couple of smaller checks from VCs. Are you interested? Got some of those investments. And then so by the time he went and approached Khosla Ventures, he had $1.5 million committed. And the conversation he had with Khosla was, look, we would love to have you involved in this round. We want to get back to building this business. And so we'd love to have you involved, but if you're not interested, like we have more angels that are interested, and we'll just kind of like get a few more checks from angels and just keep moving here and keep building the business, right? And call this seed round completed and keep going, right? And so in that case, he was able to like stagger things and like win with existing investors, win with new angel investors, win with smaller VCs, and then got the lead VC last, right? And so you kind of stagger things. That can help you like get wins on the board rather than just having like, we've got this big $2 million bucket that we need to fill, right? And so staggering things can really help here. So it's not always that you're going to go get a lead first. If you've got a line of sight on getting a lead first, by all means, go in for the kill and see if you can get that, because it'll make the chips fall a lot easier. But it's often more nuanced than just getting a lead first. So let's talk about prospecting and talking about people. So people are more important than firms. Fundraising is about relationships. Ultimately, is going to be people who are deciding to invest in your company, right? Even if it is a VC firm, there is going to be a partner who is sponsoring the deal, right? And so too many founders just like look at big name firms like, okay, I want to raise from first round and this other VC that I found on Crunchbase and all these investors. When at the end of the day, it's much more effective to think about the people that may exist at those firms that might understand your business, or just the people in general who are most likely to be excited about what you're building. That may help you find your way to those firms, but really focusing this on relationships and the people that you want to talk to is going to be much more effective than just, you know, starting out with firms and trying to, you know, talk to those firms. It's also just more effective than firm hunting, right? So, you know, talking to people is going to allow you to get connected to the right folks at these firms, and it's going to help you get to other investors that you may not have anticipated, right? Because well-networked people know other people who are investors that might be a better fit for you, that might not have angel list profiles or, you know, be on Crunchbase, but maybe really active angel investors. And finally, people have different roles and investment focuses. So even at a VC firm, an associate has a different job than a principal, that has a different job than a venture partner, that has a different job than a partner, right? And so understanding who those different people are and the roles they have within firms is going to help you understand how to work with that person to move quickly. And even two partners at a firm may have completely different investment focuses. So if you're just saying, I want to talk to a partner at Lightspeed and I have a second degree connection to this partner, so I'm going to try to get an introduction to that person, but that person invests exclusively in computer vision technologies and you're a food company, right? Then you're barking up the wrong tree, and it would have been good to take a different path. So make sure you're thinking about people, not just firms. So here are some good prospecting tactics. The first is good old-fashioned research. This is always a great place to start. This is a screenshot of Crunchbase. There are other tools other than Crunchbase like AngelList, Signal, other online databases that people publish. So those are really good places to look. Specifically, I'm using Crunchbase filters here, which can actually be really effective in filtering people that you might have affiliation with. In this example, I'm filtering alumni of the University of Texas, right? And so if you want to try to search for people from your alma mater that might be a little more receptive to hearing from you, that's a good place to start. So using these online tools is a good place to start building your prospect list. But I will say the most valuable prospecting tactic is other founders. So this is not just peer founders, like all of you are peer founders to each other, relatively at the same stage. If you can build relationships with founders that are, let's say, 12 to 24 months ahead of you in their startup lifecycle, then that is going to be a really valuable relationship, because not only will they have just gone through this process of raising a seed round, they're going to have up-to-date intel on which investors you should talk to and which you shouldn't. They might have more up-to-date spreadsheets that they can just send to you, right? And be like, here's all the investors I talked to. And they might be able to introduce you to investors who invested in their company, or investors who passed on their company, but that they still have relationships with. This worked really well for me with my first round, or my second round, where I had a friend who was just a year ahead of me and made introductions to some of his investors, and two of them ended up investing in my round, right? So building those relationships with founders that are a little bit ahead of you is a really valuable thing, not just for fundraising, for a lot of reasons, but it can be really helpful for fundraising. So it's helpful to build these relationships before you're fundraising. Once you're fundraising, everyone knows why you're trying to talk to people, right? But if you carve out time when you are not yet fundraising, you can build a lot of these relationships and stack the deck in your favor, so that when you do need to fundraise, you've got a pretty nice funnel. And so here's some tips for building relationships pre-fundraise. Spend 10% of your time building relationships with value adders. And so I say value adders for a reason here. So basically, you don't want to be distracted by just having conversations with investors for the sake of having conversations with investors when you're not fundraising, because ultimately they can't really help you, right? If you're just talking to people who just have money. But if you talk to people who might be investors but can actually help you with specific challenges that you're facing, that is actually a really good use of time, because they're going to help you with existing challenges. And when it does come time to raise money down the road, they're going to be able to really help you out, right? So spend time building relationships with value adders to address some of the immediate needs you have. That way, this like relationship building pre-fundraise is not a distraction to your business, but it's actually helping you in the near term. Genuinely seek help from those who can help with specific challenges. So it is not good enough to go to someone and say, love to hear what you think about my deck, or would love to tell you a little bit about our startup and see what you think. That's way too general, and people can see through what you're doing there, right? You're clearly trying to build relationships so that you can fundraise. You want to come with specific asks. Hey, you started this company that did X, Y, and Z. You really scaled through this go-to-market channel very successfully. We actually think that this channel could work for us. And would love to better understand some of the challenges you faced and see if there are any blind spots that I am having with that go-to-market channel, right? That's an example of a really specific ask. For me personally, if a founder asks me that, I am absolutely happy to hop on the call for 25 minutes because I can probably save that founder 3 months of pain right away, which is a good use of 25 minutes of my time, right? And so I think that's one of the keys here is you want to come with specific asks that can help you build that relationship. Because that people are going to be very willing to help and they're going to be able to see the results of that help. So the next thing here is show them the ROI of their time, advice, or network. If you have a conversation with someone, whether they're an investor or a well-networked founder, and you take their advice or they make an introduction, come back to them and show them what happened. Right? If they can see that, oh, I helped this founder and they act on my advice or whatever I did for them, and it actually helped their business, they become more invested emotionally in what you're doing. And it helps you build that relationship, right? And so that is a really helpful way to start building a really strong bond. But also, if you show an investor that there is an ROI on their time or an ROI on their network for your business, it's going to be pretty clear when you do end up fundraising that they might as well invest, right? Because when they provide their advice, time, or network, there's a positive impact on the business. And so they already see that there is an ROI to them investing their time. They might as well have some equity. And then finally, this is a tricky one. Allow them to look like someone with early access to startups. So this specifically applies to other founders or angel investors. If you can build relationships with people pre-fundraise, and you can give them advanced notice that, hey, you've been really helpful. Just want to give you a heads up. It looks like we might start to raise a round in the next month or so. Still working out the details. But if there is anyone in your network who you think we should be talking to, now is a pretty good time to make that introduction before we really start this process. That is going to put them in a position to go to people they know and tell them, hey, I know of a startup that is not fundraising, but that might be, that I really like, and I've been helping out, and I think you should talk to them. And that makes that person look really good, right? So putting other people that have been helping you in a position to look good to other potential investors or people in their network is going to enable them to basically build prospects for you and start to build relationships pre-raise for you. Right? When you hear stories of founders that like raise rounds really, really quickly, and it's almost like the round never really started, but it was closed before it started, they're doing a good job of this step, right? Of like teasing it out to their close inner circle of people they've built relationships with, and enabling those people to make introductions before others know about the round. So some takeaways from prospecting: 20 prospects for every spot available. Focus your prospecting on people, not just firms, and get your prospects through research and relationships. Oh, and finally, build genuine relationships with investors and founders before you raise. So these next two parts are a little faster, but I'll pause for some questions. We have a few questions here in the chat, and then we'll open it up. Please recommend tools for managing the investor funnel. Depends. Like I would just use a spreadsheet or a CRM like Streak. I used Streak to manage my funnel, but I would just use like a basic CRM tool for that, whatever you're comfortable with. So someone asked, in that case, how about if all of the follow-ons will only invest if there is a lead? If is your $1.5 million banked fairly useless in that case? And if any, okay, so I'll rephrase this question just to be clear about it. So basically, if the follow-on VCs or even angels are committing but are not writing checks, how do you deal with that when kind of approaching the lead? And so it's a good question. I think like it's not truly invested until the money is in the bank. You can talk about that like you have money in the bank, you have soft commits, and you have like people that you're in the funnel with. So I would say that, look, like you might have a couple of angels that are committed. You may have follow-on VCs. Those are the most common ones to not truly commit, but to wait and see for a lead. In those cases, I would tell the lead, like, be honest that, we've got this much money committed. We have follow-on VCs that are interested if we get a lead. But you should also have a contingency plan there, right? Like, you should be continuing to talk to follow-on VCs until you get money in the bank. So if other follow-on VCs are like, I'm going to wait until there's a lead, you should continue talking to other VCs that might be willing to just write a check. So you should try to build more competition there. Ultimately, people are always going to wait and see until they feel like they're about to lose out. And so I would try to build the funnel of follow-on VCs, because oftentimes there will be follow-on VCs that will write checks. If you have ones that are kind of waiting to see, you should be putting pressure on them by finding other VCs that might be willing to write checks, right? And then you can communicate to those VCs that are stringing you along. You can be like, look, totally hear where you're coming from with a lead VC. We have other smaller VCs that are interested. And, that might push them to be like, okay, maybe we need to make a decision here.
Excuse me, I'm a little bit confused. You said that follow-on VCs write a check before there is a lead. That means that they lead. Otherwise, how do they write a check? Yeah.
So when I'm referring to lead, I am not talking about chronologically the first investor. I am talking about basically the anchor investor that is writing the biggest check of the round. That will generally set the terms for the round. We'll talk about this in a second of the dynamics of how this works, but you can get commitments or even investments from follow-on VCs before getting a lead. So sometimes it'll work that they'll give you a hard commitment and say, as soon as you have a lead, we will absolutely write the check. You shouldn't count it until the money's in the bank, but you can absolutely get smaller checks from smaller VCs that are not technically leading your round before you get a lead investor.
So that's under a safe or something like that?
Sorry, say that again?
So if the terms are not determined, is that under a safe or similar structure?
Yeah, so let's talk about this really quickly. There are a couple ways this can work. So especially with this bottom-up approach, you're basically setting your own terms without a lead coming in and telling you what the terms are, right? So when you're setting your own terms, let's say you start with, we're going to raise at a $6 million valuation cap on a safe or convertible note, whatever it is. You're going to be getting initial investors in on those terms. And then if you then talk to a lead VC later who wants to invest at a lower valuation cap, what you would then do is you would say, okay, we'll do that. And you would go back to your initial investors that committed at a higher valuation. And you would say, look, we got a big lead investor we're really excited about. We're going to bring everyone down to the valuation cap that they set, right? And no one's going to be upset with that. You're basically telling them that they're getting a better deal than they thought, right? But you're kind of bringing everyone into the terms that the investor set. The other example is you start with a lower valuation, like $5 million cap. And as you go along with your fundraise, things start to move really quickly. And you actually have a lot of demand towards the end for lead investors. And they actually set the cap higher at 7, or you set the cap higher at 7 because there's so much competition and you feel like you can do that. In that case, the earlier investors would basically be getting rewarded for taking the earlier risk. You wouldn't change their valuation cap. They would still have the same investment at a lower valuation. They would just have already technically appreciated their investment because a newer investor came on later at a higher valuation, right? So those are the two scenarios. You do have to start somewhere to start having these conversations and start having money in the bank. But especially with safes and convertible notes, you do have a little bit of flexibility to go back to your earlier investors and amend things, especially if it's advantageous to them, right? So those are the two ways that it can work. That's very tactical. tactical, but like I just wanted to address that really quickly because it's a very good question.
Thank you.
Someone asked, how should we answer if an investor says, come back when you have a lead? Look, I think like you should be, first of all, like I said, you should be building a funnel of other follow-on investors, right? So you should be like, look, just want to let you know, we're going to continue talking to other VCs and we'll keep you posted how those conversations go, because like we might get other VCs that want to take this spot. We will come back to you if we have an investor. We'll keep you updated with how things go. But honestly, if an investor wants to take that stance, they need to understand that there is risk of them missing out, right? And so again, don't be too cocky or arrogant with how you communicate that, but just be like, hey, totally understand. Just so you know, we're going to keep having these conversations with other folks. So that's how I would do that. And if you do secure a lead, then yeah, go back to them, let them know, and they might be willing to write a quick check.
Hi, can I ask a question?
Sure, we have a question.
Yeah, I had the same problem actually. I found 3 different angels and 2 follow-up VCs, but I couldn't find a lead investor. For example, one of them emailed to me last week, do you find your lead investor and what's going on? And I couldn't know how should I answer it. And I said, we're still looking for a lead investor and hoping to find the next feature, but I don't think so. They would like to invest. Whether I can find a lead investor. Do you have any tips about it? Because it's a really big barrier, I think.
Yeah, so I'll answer a little holistically here, and let me know if this answers the question. You know, it's not a yes until the money is in the bank, just to be clear, right? And so I think if you have investors that give you the, you know, once you find a lead or give you the conditional commitment, you should, like, that's better than a no in some cases. But you know, you should keep finding investors and keep having those conversations. Ultimately, if someone wants to take that stance, there's a good chance that you will find another investor who is willing to move faster, and they will take that investor's spot, right? And so I think when you have those conversations, you can be like, look, totally understand. Just want to let you know we're moving quickly and we're continuing to have conversations with investors. We can keep you apprised of how things are evolving. But for you as a founder, you should be like continuing to find investors. So don't treat the conditional yes as like, okay, good, got that part of the round figured out. You should be continuing to build that funnel and continuing to talk to new investors until you actually have that spot filled, right? And so I think it's like, you should understand where investors come from if they're being risk averse, but ultimately it's on you to continue to build prospects and find investors that will say yes and will write a check right away, because there are investors out there that will. So I know that's like a little meta, but I would just treat it as like not a closed investment in your head. Even if when you're talking to other investors, you might say like, yeah, we have people like soft committed. I would just stay aggressive in finding new investors that might end up taking that other investor's spot.
Okay, thanks.
Cool. We'll have time for more questions, but I want to keep going here. So let's talk about initiating fundraising mode and stacking up meetings. So first step here is to build relationships before turning on fundraising mode. We've talked about this. If you can build these relationships and warm people up and kind of let the water levels build a little bit before pulling down the floodgates, that's going to be really advantageous. So build relationships before turning on fundraising mode. Then make sure you have all of your materials. So that includes a teaser deck. So it's just like the deck you'll use to get an initial meeting with an investor, a full presentation deck and readable deck. So this might be what you send after a meeting or present with if you're doing a partner meeting, a supporting financial model, and then a safe or convertible note. So you want to have all of these things together before you start talking to investors. I have a really painful story. personally with this, I did not, when I started talking to investors for my first round, I did not have a convertible note ready. The first investor I talked to who said yes would have wired the money that afternoon if I just would have sent him all of the docs right away. Instead, I had to go back to my lawyer, get the docs written up. A week later, I sent him everything. It ended up taking me 4 months to close that one investor, right? So when you have someone who's hot to trot, ready to write a check at a point of conviction, you need to have all of this stuff ready so you can move them as quickly as possible down the funnel and get the money in the bank. So have all of this stuff ahead of time. Then you want to quietly close at least one investor. So we had a question. I saw a raised hand.
Yeah, sorry. What if you're open to negotiating terms? And so wouldn't it be fair that you wouldn't have things ready to go because you're trying to keep it open for their benefit?
I would still have.
Sorry,
I would
if you're in
still
like a
have,
seed round.
Yeah. I would still have, like, you should be starting somewhere. And really the only terms that you should be flexible on are more of the simple ones, right? Like valuation cap, discount, like those are the basic things that you would be flexible on. I think if you are willing to put higher things into question, like, is this an uncapped safe or versus a capped safe? That's a higher level question. Then I would have both ready, right? I think like it gets back to the question that we answered before, which is as you go through this process, the valuation as you talk to more of the investors might go up or down, right? And so if it goes down, then you're going to want to do right by the initial investors that committed at a higher valuation. If it goes up, then good for the initial investors that took the earlier risk. But you are going to want to have something so that you can get money in the bank. If someone's like, yep, I'm in, let's do this thing, right? So it helps to start with something. And look, like you might change the valuation cap, which is just changing a number. But in terms of like the actual doc ready to sign, you should have that stuff together. Good question.
Can I ask a question?
Sorry, what was that?
We have okay. I want to ask that we are under SOSV portfolio. We have for example, we have convertible agreement with SOSV. So should we need to prepare another convertible note?
Sorry, I couldn't quite understand. Can you repeat that?
Wait a minute.
Me? Hello.
Hi.
Hi. So I'm saying you said your convertible note should be ready. So I'm asking, we have a convertible agreement with SOSV, for example.
Mm-hmm.
Is that apart from that convertible note, convertible agreement? Because we have already a convertible agreement. So
Yeah. You should be considering that with your round, but ultimately, if you're raising like a new $500,000 round or something like that, you're going to have different terms for those new investors than with SOSV, right? And so you would create a new convertible note.
Okay.
Or a new safe, yeah. So want to return to this, and we can ask questions at the end. So you want to quietly close at least one investor, and then turn on fundraising mode. It's a big difference between starting to talk to investors and having 0 investors versus having 1, right? So try to close someone in your inner circle if you can, and then turn on fundraising mode. And when you turn on fundraising mode, you should be working, whichever part of the funnel you want to focus on, you should be working to get as many introductions as fast as you can to all those investors. And then as you're going through this process, keep filling the top of the funnel, right? Like this is, the last thing you want to do is end up with a dried up funnel halfway through your fundraise process. So make sure you're continuing to keep this full throughout. So next we'll go into pitching and closing, and then we'll open it back up for more questions. So some goals for the first meeting with an investor. First, you want to discover if there is goal alignment, right? So if the answer is no, then you don't need to go much further. Second, you want to learn about their decision-making process in the first meeting, because that'll help you understand how quickly they can make a decision, and it'll help you understand down the road if you're getting strung along or not. Right? If an investor says we can make decisions really quickly and it's taking them a long time to make a decision, then they're stringing you along. Right? And so this helps you understand kind of how you can move through their fundraising process. And then get them excited about the opportunity. Obviously, if you don't do that, then it's not going to go anywhere. But the first two goals here are more about your goals than impressing them. So a few rules for the first meeting. The first rule, make it personal. I would usually say meet in person here. Right now, that's a big challenge. And so get creative. Like, you're going to want to do a Zoom call. Don't just do a phone call. Do a Zoom call. Try to do what you might do. Like, when you meet in person with an investor, they get a real sense of who you are as a person. So I would say in the new normal that we're in, during a Zoom call, I would spend a little bit of time like getting to know each other, right? And making sure they have a sense of who you are than just like a typical Zoom call with an investor where you start pitching right away. So try to like mimic some of the benefits that come from meeting in person over Zoom. Don't just treat it like a typical Zoom call. Rule number 2, ask questions before you start pitching. You should assume that if you talk to an investor, when you start talking about your business, you are going to spend the rest of the time talking about your business, right? And so if you don't ask your questions first, you may never get to ask them. So ask them first. This also does a really nice thing where it makes it feel a little more like an interview. And it puts you in a position of strength at the beginning, which will just give you a little bit more confidence if you start the conversation by asking them questions and balancing out that power dynamic, right? So ask questions first before you start pitching. Don't discuss valuation in the first meeting. If you have a lot of clarity and like certainty around your valuation, then sure, by all means, talk about it. But the last thing you want to do is get hung up in a rabbit hole of discussing valuation in a first meeting. If an investor has enough conviction, they'll invest at a $4 million valuation or a $7 million valuation, right? That's more about the details. The first meeting is really about getting them excited, right? So if you do get asked about this and you don't have a good answer, like feel free to punt on it, right? Just say, look, we just haven't figured that out yet. We're gonna let the market decide. You can ask them what they think the market is currently valuing opportunities like this at. You don't actually have to use that number, but I just wouldn't get hung up on valuation discussions in the first meeting. And then finally, keep it conversational. This is not Shark Tank, right? Like, this is not you sitting there and talking for 2.5 minutes and then answering questions. You may get interrupted within 15 seconds of you talking about your business. And you should embrace that. Honestly, the best conversations with investors feel very conversational. That is part of why it's really important to have that really crisp, strong fundraising narrative, so that if you get interrupted pretty early, you can at least make sure you've implanted your fundraising narrative in the investor's head, and you can dive into different parts of the business based on what they want to talk about. So some questions you should ask in a first meeting. First, what is a good outcome for you? That helps you get to the core of goal alignment. Next, what is your typical check size and or ownership target? Right, this will help you understand how they might fit into your round composition. Also, it's a nice roundabout way of understanding what valuation they'd be comfortable with. Note that the way that a lot of investors think is not about check size, but about ownership. So some investors think like, we want to get our 5%. And they're a little flexible on the size of the check based on that. And then what is your investment process? Again, you want to get that out of the first meeting. There are other questions you can ask, but these are the ones that you definitely want to ask in the first meeting, because it'll help inform how you think about the fundraising process with this investor. So here is the typical VC process, right? It starts with an initial meeting, then they might do some basic analysis, where they go into some of your competitors, then some more formal due diligence where they may talk to customers or dig around with your product. Then a partner meeting, potentially confirmatory diligence where they're dotting I's and crossing T's, and then a term sheet. At any point in this process, they might pass. One thing I'll say is embrace that. A no is way better than a maybe. Far too frequently, founders get hung up on all these maybes because, quite honestly, investors have no incentive to tell you no. If I'm an investor and I can tell you maybe, or like, yeah, come back in 2 months, or let us know when you have a lead, or insert excuse here. Basically, I am putting myself in a position where I'm not going to lose out, right? And so if you're getting strung along, feel free to write investors off in your head and just, again, try to like fill the funnel with other investors that might get to a yes quickly, right? And so you don't have to break up with investors. You don't have to tell them, we're going to count this as a no, so goodbye, right? You don't have to do that. But you can just say like, okay, like, just so you know, like we're going to keep talking to investors. We'll keep you updated, but in your head, I would encourage you to just move on and try to find new investors who are going to get really excited really quickly. Quick summary, and then I just saw a really good question from Cameron's on fire. Really good question come through, but I'll answer that in a second. But quick summary here, you're giving up scarce equity in your company, not asking for money, right? This is a recruiting exercise, not an ask for money exercise. And it's really important to have that mindset. Create a sense of urgency by cultivating authentic competition for your round. Startup investor fit goes both ways, right? It's not just you pitching to the investor, it's vice versa. Build relationships before you need to fundraise. It's going to make things a lot easier. Put yourself in a position where you'll have to say no to some investors. It's a full-time process that should be done as quickly as possible. And then remember the 3x1 rule, right? 3 investors in final diligence for everyone you want to close. And of course, experienced founders that
put a seed round together as quickly as a month. A lot easier said than done, but this is really what we should be aspiring to, right? Spend time working on this process. Well, from the point that you turn fundraising mode on, you should be moving as quickly as possible so that you can get this done, get it behind you, and continue building your business. That is.
There is a problem with your audio. I think we can't hear you now.
Something is wrong with your audio.
Can you hear me now?
It's very muffled, Mike. It sounds like you went underwater.
1 second here. What's that?
Oh, now we can't hear you at all. But I like that somebody says it sounds like a blackmail filter.
It's funny.
Hey there.
Still a little bit.
What about now?
Perfect.
Okay. I think that was like a Bluetooth surprise. Sorry about that. Where did you lose me?
The second last bullet point of the previous slide.
Ah, okay. Yeah, I mean, look, it's I think you've seen this. It's a full-time process. It should be done as quickly as possible. Remember the 3x1 rule. The main thing here is like, do this as quickly as possible. Easier said than done, but you should be thinking about doing this efficiently so that you can maybe spend time building up to the process, turn the process on, sprint as quickly as possible to get it done, put yourself in a position to succeed with it, right? So sometimes it means like starting a little lower with how much you want to raise and oversubscribing it, but try to get this done as quickly as possible so that you can move on to, you know, building your business, which is what you want to be spending your time doing. So now I've got 18 minutes that I can spare just answering any questions that folks have.
So in one of the slides, you've mentioned that there has to be a readable deck and teaser. When to use that readable presentation and detailed pitch, and why do we need like 2-3 set of pitch documents?
Yeah, so the teaser is, look, the teaser could be, 5 slides. It could be a 1-pager. It could be, I've seen it just be like an email, like a well-written forwardable email, right? It's really just like the thing that you use to get the meeting. In terms of presentation versus readable deck, it's just that like when you're, if you're pitching someone, you may use something with like not a lot of text, right? And keep the focus on you so that you can actually like present and pitch. Whereas if you might follow up via email and give them all the slides, you may send that after the fact. And that's a readable deck, right? Where you are not there to present it, but they might pass it around to someone else at the firm or something like that. And you'll want to have that in a different format. Does that answer your question?
Yes.
Cool. One question from Cameron here about non-dilutive funding. So for context, I did this for my first round. I got like a 50K, I like won a 50K competition, which was technically a grant, and used that to kick off my round. And so I think you can consider that an investor. So when we talk about like close one investor first before opening it up, you can use non-dilutive funding like a grant to actually do that. So you can just say, look, we've got, when you talk about your round composition, you basically fold it in. So, we're raising from this many investors, insert grant giver as one of the investors in one of your types, in your like types of investors or investor personas. And that's kind of how you would fold it in so that when you start having conversations, you already have some money that's been invested. And you don't have to talk about the terms of that investor. You can just say that you've got that investment. Max asked, our goal is a price round. We have a follower soft committed. You described a tactic where the first follower gets to sign a SAFE or convertible note. Can this tactic also work for a priced round? So I want to be clear, there's a difference between a priced equity round and raising on a SAFE or convertible note. Priced equity rounds are more expensive and time consuming, and you need to get everything in at once under one unified deal term, right? So it's a little bit harder to like wrangle all of the different investors and get basically all the money wired at once. So you can't do it in that way. That's one of the benefits of doing a seed round with a SAFE or convertible note is you can kind of get rolling commitments and get money closed in. The way you could do this with a priced round is you could do a first close and a second close, right? So you would still maybe not do it for one individual investor, but you would maybe say like, look, we're going to do a first close with these angels and a few small VCs. And then we're going to do a second close at a later date. And those are going to be the 2 closes that make up our seed round. But that is one of the nuances with a price round is it kind of all has to happen at once. So you could break a priced seed round into first close and second close, but things do have to happen synchronously, which is one of the challenges of a priced round. Cool. You have an investor who is positive, but at a low valuation. You find this cool. So one of the questions is just around valuation, right? So you have an investor who likes your company, but they're being harsh on valuation. And you see other companies that are raising at higher valuations. So here's how I would talk about valuation with investors. In the early stages, it's really hard to justify valuations in general, right? You're kind of picking it out of thin air. And so you can use valuations that you see from other companies that are at similar stages, but ultimately the thing that is going to dictate the valuation is like supply and demand, right? Do you have enough investors that are interested enough in this deal that you will be able to raise the valuation and essentially get away with it? Now, there are other things to consider, like you don't want to just set your valuation super high because you can get away with it, because you're going to ultimately have to beat that valuation down the road. So you want to set yourself up for success. But I would say if you're getting an investor that is being harsh on valuation, a healthy way to have that conversation is by speaking about valuation more in terms of your dilution. So it's hard to be like, hey, investor, we deserve an $8 million valuation, but you're telling us it's a 4, right? Like that is hard to have that conversation. It's much easier to say, look, this is why we want this valuation. It's not because we think we're worth this much, because it's like early stage investing. It's because this is what we're planning in terms of fundraising. We're raising this seed round, but we're also going to be raising a Series A. We're going to be raising a Series B. And here's how we see that dilution looking. And if we take on this much dilution this early, it's going to really hurt us down the road when it comes to attracting talent, when it comes to keeping the executive team incentivized, right? Like we're going to run into these challenges. And so we just can't afford to take on that dilution. That's a better way of talking about it than like we deserve a better valuation. And so one data point to kind of put in the back of your head is that the median amount of dilution that startups take on before Series A is 25%. So if you're talking to a seed investor and they're telling you some valuation that's going to result in you diluting yourself 30% before you raise Series A or 35% before you raise Series A, you can have that conversation. You can be like, look, this is how we're thinking about dilution. And therefore it's, not like this is untenable to take on this much dilution this early. So that's something you should also be thinking about before you talk to investors is like, what are you thinking about in terms of dilution? Both now.
What I did in the past is just to emphasize the problem that's going to cause the company, which if he will be part of the company, then it's a problem to him.
Exactly. Right. Like if they, I get it. Like investors want to get the best deal they can, but if you lay it out for them that like, hey, this is how we're thinking about dilution long term, it is not a good idea to peg the company at this valuation because of how we're thinking about this, and they understand that, then like they'll be flexible, or they should be.
I want to ask about just to make sure I understand. You recommend splitting to slices the different investors, like defining, for instance, a $3 million round, part of it from angels, part of it from small VCs, and part from a lead VC. So you're thinking about, for instance, this 1 month process for every segment, or you think from your experience, this could be done in a month throughout these segments? Sounds very, very challenging.
Yeah, it depends on like how big your network is, right? Like how many people you can get access to. That is where staggering can work to your advantage, right? And so like I've seen it where, because the key here is just being efficient with your time. Right. And so, look, if you want to spend 3 weeks sprinting on the angel portion and saying like, look, we want to raise 600K from angels, you can do that. You can like get that done, take a breath, right? And then be like, okay, now we want to like sprint on this for 2 weeks with lead VC. So I have seen folks kind of triage it out. It depends on how confident you feel in the funnel that you're able to build. And so I would say like what you don't want to do is be like, we're raising a $2 million round. We're going to like start this process. And then you're just kind of like chipping away for 4 months and kind of like pushing a boulder up a hill. You want to put yourself in a position so you can like get wins on the board, right? So even if that's starting with angels and getting that done and being able to be like, yes, we got this 600K angel commitment done. Then you can move on to other things. So it might take 2 months, but I would really caution against like, I see a lot of founders spend 2 months trying to find the lead and not getting anywhere. And in that time, they could have been getting smaller commitments from angels and smaller VCs. but 2 months go by and they're right where they started with fundraising, right? So like put yourself in a position where like if you do want to stagger it, I think that's really effective. And like maybe this does take 2 months, but I think like my thinking here is you want to go as quickly as possible. So it may take longer than a month. I fully acknowledge that, but like you want to put yourself in a position where like maybe it could get done in a month, right? That may take 2 months of prep, right? To kind of like build things up and get things going before you switch it on. But in terms of when you are in market, you want to be in market with whichever investors you're talking to for as short a period as possible.
And can you
So you
also
said-
say a word about the environment in the US now for all of us outside of the US with the investment?
Yeah, I think it's changing very quickly, right? So I think right now is just a time of tremendous uncertainty, and so what we may see in 2 months might be very different from what we see today. I think there are a lot of angels who are maybe being more conservative, right? A lot of VCs are investing more in like existing portfolio companies that are winners, and like focusing on existing relationships that they have because they're not able to like build in-person relationships. But there are also like there are also counters to that, right? Like there are plenty of investors that are still writing checks to new companies. Look, one of the things I'll say is some of the best venture deals of all time happened in 2009. Investors know that. Right now is a time of a lot of opportunity, even though it is also a time of like uncertainty, right? And so I think understanding if you like some founders are in a really good position to raise, like if you're doing things in the future of work, or if you're doing things that are like poised to take off because of current events, you might be in a really good position. I think you have to talk to investors and understand, right? Like it's going to be different for each investor, what their strategy is. I know some investors that are like being more aggressive right now, but I know more investors that are being more conservative right now. One quick question we had in terms of minimum check. Yeah, I would highly advise having a minimum check size. I would generally say like 25K is a good minimum, maybe 50K for angels. You can make exceptions if you have like an advisor who's been really helpful and like literally all they can afford is to write a 10K check. Then like maybe you make exceptions. But I've seen it where a lot of people will default to the minimum check size. And so even if you told them that it was a 10K minimum, they would write a 10K minimum. If you told them it was a 50K minimum, they would write a 50K minimum and not think about it, right? So like, I would say 25 to 50 is a good, healthy minimum check size, depending on how many angels you want in your round. And that gets back to round composition. There was one question around balancing fundraising versus building traction. I would encourage you to think about your fundraising narrative. That fundraising narrative we talked about is not just a fundraising narrative, it's how you should be thinking as an operator in terms of like de-risking the business. And so you need to be working on getting the business to a point where you have a compelling narrative to where it is clear what you've de-risked, what you need to de-risk next, and that like is very obvious that you should be raising around to de-risk that, right? And so kind of work backwards from what your fundraising narrative would be today and what your fundraising narrative could be in the future, and be honest if your fundraising narrative is compelling enough to raise around on, right? And you can ask people, right? You can ask close advisors who you trust, but I would say, be honest with where you are, because it might be that you're just two months away from having like what is not a compelling fundraising narrative to an incredibly compelling fundraising narrative. And if that's the case, then just like focus on getting those milestones so that you can de-risk the business and be in a position where you have a really compelling narrative. And that would be a better use of time. And so I encourage founders to always think about those questions involved in the fundraising narrative, and using that to like figure out how ready they are to actually fundraise. Cool. Got 2 more minutes, but just so you all know, I'm going to be sending out these slides. Also send out information about like the benefits you get from AWS in case you're interested in that. I'll make sure you have everything. But you also have my email address. So if you have any questions, feel free to reach out. But yeah, thanks everyone for joining and sticking around. I know this was a long session, but I appreciate your time.
This is great, Mike. Thank you so much. This is really helpful for folks. And I can almost assure you there will be follow-up from people.
Yeah. Great.
Yes.
Oh, sorry.
No worries.
Anything
I was
else?
just going to say thanks, Mike. Appreciate it. And I'll follow up with you and we can coordinate how to get all this stuff to everyone.
Perfect. All right. Y'all have a good day. Stay safe.
Thanks, everyone.
Thank
Stay
you very
safe.
much. Very
Thank
helpful.
you.
Great presentation.
Thank you so much. Thanks a lot. Bye.